one of the biggest mistakes beginners make when they first start trading options. And so remember, before you ever enter any options trade, please make sure you know how to close it. I'll pin a video in the comment section below where I show you guys how to close out of any options trade. Let's start off by going into the options here for a stock. So I'm gonna be using ticker symbol AAL, American Airlines, here for today's video. So let's go into the options here for American Airlines. Now we're going to be focusing on buying options today, okay? So buying calls and buying put here. So let's say we wanted to buy a call on American Airlines. So buying a call is a bullish strategy. And keep in mind, this concept that I'm going to talk about is also the same for buying puts. But I'm just going to stick with calls here for today. So let's say I wanted to buy a call on American Airlines. Now there are two key decisions here that need to be made. What are these decisions? So the first one is choosing the proper expiration date for this call that I'm buying, right? So you can see I'm on buy, I'm on call. Right now I have my expiration date as March 11th. So I'm not going to go into this part here, the proper expiration, but for today's video, I'm going to be using March 18th. So that's one key decision that needs to be made when choosing your option here. The other very important key decision that needs to be made, and what I want to talk about here today, is choosing the proper strike price. Because as you guys can see here, right now I'm on buy, I'm on calls, I'm on the March 18th expiration, but there's a ton of contracts here. There's a lot of different contracts here. So how do I know which one I should choose? What's the difference between all of these? What's the pros and cons between all of the different strike prices here, all of the different options that I see here? That's what I want to focus on here today, because if you're choosing the wrong strike price, you may end up losing a lot of money. So let's go over what the proper strike price you should be choosing is. So what I'm going to do here is I'm going to start by splitting the options here into two separate categories. Now, these two categories are going to be in the money options, and then the other one's going to be out of the money options. So for calls, in the money call options are options whose strike price is less than the current share price. So current share price of American Airlines is $13.18. So all these options under this green line right here, the strike is less than the current share price. These are all in the money call options. Now, what are out of the money call options? Out of the money here is going to be where the strike price of the option is higher than the current share price. So again, all the options above this green line are out of the money because the strike price is higher than the current share price. So now that we've split up these options into two different categories here, we can basically start kind of going down what the pros and cons are to each one of these categories here. And so what I'm going to first do is I'm going to go over to option strat, and I'm going to basically go ahead and go into a long call and do one that's out of the money and one that's in the money. And this is going to allow us to compare and kind of take a look at what the difference is between the two. And this will be easier to visually see what I'm talking about here. So let's go quickly over to option strat. Let's go to build here, and let's go to long call. And so I'm going to first start by going again to the ticker symbol I'm using, American Airlines. I chose March 18th as my expiration. So let's first go ahead and buy an in the money call here. So again, in the money call is where the strike price is less than the current share price. So current share price is around $13.20. So I need to choose a call option with a strike less than $13.17. So let's say I want to buy a call at the $12 strike. So here we're buying a call that's in the money. So this is an in the money call option. This is what it looks like here. Okay, now I'm going to go to another tab here for option strat, and I'm going to buy an out of the money call option. So again, I'll go to build here, long call. We are using AAL here for today's video. So AAL, and then we chose March 18th. And so again, out of the money now is where the strike is higher, greater than the current share price. So greater than $13.17. So for my out of the money call option, I'm going to choose the $15 strike. So here's what it would look like to buy an out of the money call option. So now that we have these two, we can visually take a look at both of them, compare them, and kind of see what I'm talking about here today. So the very first thing I want to talk about here, the differences between the two. First one is sensitivity to the movement in price of the underlying stock. What do I mean by that? Here's what I mean. In the money, call options will increase more when the share price goes up, right? Because, and that, by the way, that's known as delta, right? So, for example, these are all the in the money call options. So the in the money call option I chose was a $12 strike. If I click on this, what is delta? Delta, remember, is one of the Greeks here. Delta here is 0.7447. So delta tells me how much the value of this option will go up or down by with a $1 increase or decrease in the price of the stock. If I were to buy this call option right now and American Airlines goes up by $1, the value of this contract will go up by 0.7447. In other words, I would be up $74.47. However, the opposite is also true. If I buy this call right now and American Airlines drops by $1, then the value of this contract will go down by 0.7456, or in other words, I would be down $74.56. If we take a look at the out of the money call option that I chose, what do we see about delta? Delta is a lot less, right? And so if American Airlines goes up by $1, the value of my contract will only go up by $22.79. Versus over here, if I had bought this call and it goes up by $1, remember I would basically be up $74.36. And again, if American Airlines drops by $1, then the value of this contract will only lose about $23.19. So when you're using an in the money call option, it has higher sensitivity to the movement in the price of the underlying stock. So I just showed you there. If the price increases, the value of the contract will go up a lot more. But if the price of the stock also decreases, the value of the contract will drop a lot more if it's in the money. So that's the very first thing you need to take a look at and that you need to understand. Okay. Now let's go on to the second point here. In the money calls have a higher initial value. And basically what that means is that it's less risky. And the best way to see this is by taking a look at what happens if I buy this in the money call option and then I buy the out of the money call option and the price of the stock just trades sideways. So let's go over to option strat here. So let's go over to the in the money call option. So again, AAL right now is 13.17. What happens if this stock trades sideways and I have this in the money call option? Well, let's take a look here. If it trades sideways on the expiration date, I'm only going to lose $47. It's still a loss, but guess what? It's not a 100% loss. It would be a 28% loss. Now let's take a look here at the out of the money call option. So let's go to the out of the money call option. Now, what happens here with the out of the money call option if the stock just trades sideways? Well, guess what? I'm going to lose $23, which is all of the money I put into the call. In other words, percentage-wise, I'm going to lose 100%. So in the money call has a higher initial value. It makes it less risky. We can see that here, right? If the stock trades sideways with the in the money call, we're not going to lose 100%. We're only going to lose about 20% versus the out of the money call, we're going to lose 100%. And so in other words, the in the money will still have some value. The out of the money here is going to expire completely worthless. And so basically in the money call options are less risky. In the money call options have a higher probability of being profitable, right? And again, this makes sense because if we go back to the in the money call option, what's our break even? Our break even is 1367. If it goes above that on the expiration, we start to make money. What about the out of the money call option? What's our break even? 1523, right? So now American Airlines has to go all the way up to 1523 just for us to break even on the out of the money call option. Whereas in the in the money call option, it only has to go up to 1367 for us to break even. And so the probability of American Airlines going to 1367 is is a lot greater than the probability of it going up to 1523. Because if it goes up to 1523, then it has surpassed 1367, right? So again, the second point here is that in the money call options are going to be less risky, and they're going to have a higher probability of being profitable. But now let's get on to the third point here, okay? In the money calls may be less risky, but guess what? They are more expensive, right? And this is why usually a lot of traders go for out of the money call options instead. And we can just see this right off the bat, right? For our $12 strike option that's in the money, we have to pay $171 for this call option. And so we're risking $171. Now, if we're looking at the $15 strike, the out of the money call option, this only costs $24. So in the money calls may be less risky, but they're more expensive. So from a dollar perspective, you have more to lose with in the money call options. Yes, they may, they have a higher probability of being profitable, but you're also paying more. So again, from a dollar perspective, there's more to lose than the out of the money calls. Out of the money calls are going to be more cheap. And again, that's for a reason, because they are a little bit more risky. There's a lower probability of them being profitable. And again, we can see this from option strat, right? Our max loss, 167 for the in the money call option. For the out of the money call option, our max loss is only $23. So again, in the money calls, they do have a downside, which is they're going to be more expensive. They're going to cost more. And so from a dollar perspective, there's more to lose, right, from in the money call options. Now, one last thing here, point number 4 that I want to mention here. Out of the money calls can have much larger gains percentage-wise than an in the money call option if the stock surges past the strike price on the expiration date, and even before as well, right? And we can again use option strat to visually see this. So let's take a look here. So if I go back to my in the money call option here, so let's say that let's say that by on the 18th, which is the expiration, let's say AAL has jumped up 30% by then, right? Which is going to be right here, 1710. It's jumped up 30%, right? This is telling me that I would make about $343. But that really doesn't tell us much. We need to take a look at this again from a percentage standpoint. So from a percentage of max risk, that would be about a 205% return. Okay, if American Airlines jumped up to 1710. Okay, that's a pretty decent return. But now let's take a look here at the out of the money call option. If we take a look at the out of the money call option, and again, let's say the same thing happens. American Airlines jumps up 30% to 1710. Now what happens? Again, from a dollar perspective, it's 187. But again, we shouldn't be taking a look at that. We should be taking a look at percentage terms. So if we look at percentage of max risk, what do we see? 813% return. And this makes sense. Why? Because we initially paid a lot less for this option. We only paid $23 versus the in the money call option, we paid $167. I mean, we basically paid, almost 8 times as much for this in the money call option. And so if the stock makes a huge move up here with the calls, with the out of the money call options, you're going to have much larger gains, percentage terms, than an in the money call. And so that is a benefit of out of the money call options, right? And so, for example, and a lot of people like to look at more from a dollar value, but again, you should be taking a look at it from a percentage value, because again, we're putting $167 here into this in the money call option. So if I did the same thing over here and put about the same, let's take a look at what happens. Well, now let's take a look at our profit loss, $1,496 here, right? Versus again over here, it's only going to be $343. So, and again, we're pretty much about the same when it comes to the money that we're putting in. So as you can see, right, when you're buying out of the money call options, if the stock does make a huge move up, out of the money call options can give you much larger gains percentage terms than in the money call options. And so again, this concept is also going to be the same for buying puts, right? And so this is a big mistake, again, a lot of beginners make when trading options, not choosing the proper strike price. But hopefully with what I've shared with you here today, you get a little bit more understanding as to when you would want to choose an in-the-money call option, when you would want to choose an out-of-the-money call option or put option, whatever it is, and kind of the differences, right? So just a quick recap here. With in-the-money call options, they're going to be more expensive, right? It's going to cost a lot more money than out-of-the-money call options. However, there's going to be a higher probability of it being profitable, and thus it's going to be less risky. But since it is more expensive from a dollar perspective, there is more to lose. Now, when it comes to out of the money call options, and let me just again go back down to only one here, it's going to be less expensive. For example, here it only costs, only about 1/8 the price of the in the money call option that we were taking a look at. But it will have a lower probability of success. In other words, it's going to be more risky. But again, if the stock does take off, if the stock does go up in price a ton past the strike of the option you bought, you're going to make much larger gains percentage terms than the in the money call option, right? But again, it is going to be more risky. And again, we can see that by the fact that if the stock trades sideways on the expiration, it's going to expire worthless and you're going to lose 100%, right? So those are kind of the differences there between buying in the money options versus buying out of the money options. If you guys have any questions about anything I just talked about, feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.